Hi again, Alan here, and we're picking up on page 135 in chapter 4. Okay, this will take us roughly half an hour. All right, so after introducing you, to the concepts of how different accounts are classified, some assets, liabilities, equity, I gave you this master list. Always have this by your side, please, as long as we're doing these chapters on entries and transactions. And I emphasize to you that because we're using a double entry system to match the equal sign of a master accounting equation, we have to follow a twofold approach to showing all the increases and decreases that can happen. So to do that, we've established certain rules, just like you have certain rules in sports. We have to follow certain rules in maintaining an accounting procedure for someone else or even for our own business. So what I did is I took the items that increase with a debit, which means left, okay, and I made them kind of a pinkish orange. And the ones that increase on the right or credit side, I've made green, okay? So the pink ones generally have to do with some type of a cost, present or future, and the green ones have to do with a source of funding, okay? That's a fancy way to put it, but really, if you just memorize the mechanics of assets, liabilities, and equity, you should be fine. I further pointed out that equity, see my blue arrows there, equity contains both capital stock, which is contributed capital from the owners, and retained earnings, which is the accumulated balance of all profits we've ever made, all added together, okay? Minus any dividends. Okay, and then I put the so-called temporary accounts together. And those are where we will temporarily measure all our revenues and expenses. We need to break them out by any one of many account classifications, because you can't control and run your business unless you know exactly where your money's coming from and how it's being spent. And there could be hundreds of these accounts. So if you're in control of your business, you're going to want to know, how much did I spend on my rent? How much did I spend on my utilities? How much did I spend on payroll? So rather than touching equity or retained earnings for all of these detailed items that you as a manager need to know, we accumulate them in these temporary revenue and expense accounts. And then every so often we're going to stop, add them all up, and stick them back up in retained earnings where they belong. Okay? And dividends I put off to the side and put it in yellow, because we've got to remember dividends are not an expense. Okay, but we do set up a little temporary account for them, so we're going to have to close that one up to retained earnings sooner or later anyway. Okay, one other thing I want to tell you is that you will be putting all kinds of debits and credits into these accounts as you conduct business. And every so often we're going to stop, add up all the debits and credits, and see what the balance in your account is, in any one account. All right? Usually, not always, but usually, the balance of an account will appear on the side where the increases happen, okay? So we would expect that liabilities would have a credit balance on the right side when you add up all of the ins and outs, okay? Same with revenues. Assets, on the other hand, or expenses, we would usually expect to see a debit balance there, okay? So now we need a place to start. Now, if this is a brand new company that's never done business before, they don't have any books yet, okay? They have basically all zeros. And they'll try to figure out what accounts they need. So now what we're going to do is take a company that does exist called Lawndale, and all of the balances in those little T accounts, which we collectively call the ledger, okay? We're going to stop and we're going to grab them all the debits and all the credits. And if you were making debit and credit postings that were equal to each other in your entries, then all of your balances should equal each other as well. So the purpose of this document, known as a trial balance, is to demonstrate that for us, okay? So I'm not going to blow it up to full screen, so hopefully you can see this fine. If not, I have posted this slideshow for you already, so you do have access to it. So certain accounts, like cash, accounts receivable, and inventory, we know those are asset accounts. They increase on the left side, so usually we'll expect to see them with a debit balance. We didn't calculate these numbers. This was given to us by the authors right out of the book, okay? The next few accounts, accounts payable, insurance payable, notes payable, those are all liability accounts. So we would expect them to have credit balances, and they increase on the credit side also. And you can see they do. So all we're going to do is list all our debit balances in one column and all of our credit balances in the other. And if you did everything right, add them all up, and you can see they equal $370,700. Okay? And you add up the credits, and so do they. The trial balance balances. Very important that you realize that doesn't mean your books are perfect. There could still be errors in here. It's just that they happen to balance. But if someone makes an entry for the wrong amount, they went to write down 1,000 and instead both their debit and credit equal 100, the books will still be in balance. So the trial balance is not error-free necessarily, but it's a step in the right direction. It proves one thing and one thing only, friends, that your debit balances equal your credit balance, and that is why we call it a trial balance. Now remember, this is not your set of books. This is a picture of your set of books before you start doing all your accounting reports. Okay? So we're going to put some new transactions into here, but this time, unlike my last couple of lectures, we're going to do it more formally. This is how bookkeeping really gets done. Okay? Now, we're going to review all the transactions that we did. We've already seen these, no surprises. I explained them all to you. It's just that we were doing them loosely and informally. Now we're going to formalize them. Remember, this is going to go into a diary, a journal. That journal is chronological, minute by minute, transaction by transaction. You're going to keep a diary of everything your business is doing. That's what it is. It's a big diary. Okay, we call it a journal, but it's really just a diary. Then once a month usually, or whenever you want to actually, we're going to stop. We're going to take all of those entries in the diary and we're going to carry them over into the set of books that we call the ledger. That's that family of little T accounts like you see over here. That is the ledger. That plus the journal represents what people call your set of books. Okay, and when you put something in these accounts, it is there for good, permanently. No erasers, no whiteout, nothing like that. Okay, a permanent record, a trail must be maintained because that's how we'll prove that the numbers are fairly presenting our position when the next time we do it. Okay, remember, we want a set of statements that is free of material misstatements, errors, fraud, that are big enough to make a difference in your decision. So here's the first one. If you remember transaction 1, we bought inventory on credit. We know inventory increases. We know inventory is an asset, and asset accounts increase with the debit. Okay? So inventory goes up, and you can see over here, we increase an asset with the debit, and we create a liability. Why? Because we bought it on credit. So come over to my little cheat sheet over here and say, well, accounts payable is what kind of an account is it? It's a liability. Liabilities increase with a credit. So we have a debit here, a credit here, and that represents, if you add a description and a date to this, that tells you what your journal entry would be, formally, okay? You would also number these entries sequentially. This is the entry number 1, okay? So if you number these, put down a date and put down a description, a very brief description, that is one full formal journal entry. Okay, and again, every single minute that goes by, and even a small business, a transaction will be happening. Someone's job is to keep track of all those transactions by putting them into that journal, into that diary. All right, we go on. All right, we paid salaries of $300. We know salaries are an expense. Look over here. Expenses increase with the debit. Okay? Now down here, we don't care for debits because they take away from our wealth. We'd prefer to see credits, usually from here, revenues. Okay? But this is an expense. This takes away from our wealth. So we're going to debit salary expense. and we paid. That means we decrease cash. Cash is an asset, and that decrease therefore happens with the credit. All right, so you're going to say what accounts are affected and by how much. What type of accounts are they? Assets, expenses, liabilities, revenue. And then knowing the roadmap over here, we're going to come up with the appropriate debits and credits in this entry. Okay? All right, next. We borrowed money. When you borrow money, cash being an asset goes up. That would take a debit. Okay? Notes payable is a liability. Whenever you see the word payable, that's usually a liability. And that has just increased. You all of a sudden have increased how much you owe this bank. So liabilities increase with a credit. So this is your entry. A debit to cash, a credit to notes payable. Okay. Now I'm not putting this stuff into those little T accounts in my ledger yet. I'm going to do that all at once when it gets to be the end of a month. For now, I'm just going to keep my diary going day by day by day. All right. What's next? We sold inventory on credit. I told you we have to make 2 entries for this. Okay? This is the first entry. We bought the inventory for $2,000. Now we're selling it for $5,000. Remember that? The first entry we make is to record the sale. And it is being made on credit. So that's an account receivable. That's an asset. It goes up with a debit. Sales, that's a revenue account. That increases with a credit. Okay, don't take my word for it. Keep looking over at the little roadmap I gave you. All right, the second entry you have to make is to drag the cost of that inventory from the assets over to the expenses. Okay, and we call that specific type of an expense cost of goods sold. All right, by virtue of selling it, our asset has now become an expense. And it has to accompany the revenues from the sale we made. So, in order to increase an expense, I debit cost of goods sold. And to decrease an asset, inventory, because I don't have it anymore, I just sold it to you, I am going to credit inventory, an asset, for $2,000. Okay. Accrual accounting, again, I explained to you in my last lecture, simply means that we separate timing of revenues and expenses when we earn them or incur them from when cash actually changes hands. They can be 2 separate events. I could sell you something for cash right now. I could pay you in cash right now. But accountants have to actually take every revenue and every expense item and say, do I have to record this now? Not later when cash changes hands. Okay? If the answer is yes, then we have to follow the rules of accrual accounting. Okay? All right. There are 2 elements to accrual accounting. I just alluded to them a moment ago. When do you record revenue? Not when you collect the cash necessarily. Unless I'm selling to you for cash right now, then we would do it. We would show an increase in revenue and an increase in cash. But the revenue recognition principle says not when the money changes hands, because it probably won't. We'll probably buy on credit, or you'll buy on credit from me if this is my company. So we say to ourselves, have we earned the revenue? If the answer is yes, forget about the cash. If we've earned the revenue, I have to record it now. I must record it now. All right. 5 steps. If I'm selling you something on credit, identify the price, okay? Identify every obligation I have with you to make sure that I have indeed earned the money, okay? Example, if I promise to mow your lawn next week, okay? Have I earned it? Do I recognize the revenue now? Well, the answer is no, because I haven't done the work yet. Next, all I've done is make a decision and an agreement with you. So, next week, when I do the work, regardless of when you pay me, that is when I will record the revenue. The work is substantially done. Okay? I could change my mind and not mow your lawn. Or my lawnmower could break. Well, you're not going to pay me if that happens, right? Okay. All right, we determine the price of this actual specific transaction next. Okay? Then let's say that I'm going to do a whole summer's worth of landscaping for you, and we agree that I'll do that for $1,000. You're probably not going to want to pay me in advance. And you're probably not going to want to pay me cash as I do the work either. So what I will have to do is I'll have to say, well, I'm going to spend so much time mowing, so much time raking, so much time mulching and fertilizing and whatever landscapers do. And I'll assign a piece of that 1,000 to each one of those obligations. Okay? So the first time I mow your grass, that amount of the $1,000 assigned to mowing that grass, I've earned. Do I record the entire 1,000? Not if the work isn't done. Okay? So I have to allocate that price to everything I will do for you depending on what it is. And finally, as number 5 says, as I do satisfy each promise, each obligation I have to you, that's when I recognize the revenue. Hopefully a short while after that, you'll send me a check. Okay? The second half of accrual accounting is matching. Now, because expenses support revenue, okay, with really only one exception, that being taxes. Let's not worry about income taxes, okay? That's why it has its own line. But every other expense pretty much supports revenue. So if you recognize revenue, like when I just mowed your grass, any expense that I incur, whether I pay it or not, has got to be put into the same period so that it follows the revenue. Just like we do with the $2,000 worth of cost for the $5,000 of inventory that we sold. Okay? Now, since cash is probably not changing hands, that means we have to make what's called an accrual entry. We have to pretend we're paying for it. We're creating an expense and creating a liability because we're going to have to pay it later. That's a liability. Okay? That is, in essence, what the accrual system means. Okay? All right, so what else do we have here? This is where we paid $700, and we had been accruing our insurance over the last several months. We hadn't paid it. Well, we're paying it now. Now, we've already recorded the expense using this accrual method. I recorded a little bit of expense for 1 month, another month, and I've been building up a liability to my insurance company called insurance payable. As I did so, I was increasing expenses with a debit. That's what they're telling us here. I didn't see that in the past. I am believing it. They have told us this. Okay? In fact, I'm just going to go back and take one look at something. Let's go back to our trial balance here. See that insurance payable? There it is. That's the $700 we're dealing with right now. Now it's time to write them a check. All right. So we know that I am eliminating a liability. Liabilities from my map decrease with a debit. So I debit liabilities and that liability is gone. It had a credit balance before, didn't it? Back in the trial balance I showed you. What else do I do? The other side of my balanced entry will be to decrease cash because I'm writing a check, and cash being an asset decreases with the credit. Remember, you can pause me as you're watching this, go back, play it again, make sure you understand it, okay? I will need you to understand this so-called accrual accounting technique thoroughly. All right, this is where we bought a truck. Trucks being an asset go up by the full cost of $40,000. The thing is, we're not paying 40, we're paying 10. All right, so cash decreases with a credit by 10,000. Notes payable increases with a credit by the remaining 30 that we owe the seller in the future. Once again, balanced entry, 40 of debits and a cumulative 40,000 of credits. Okay? Once you do a few of these, you get used to them. You get used to thinking in terms of all these account rules that we're following over here. Liability. What kind of an account is that? Is that a liability? Oh, okay. It's decreasing on the debit side, left. It's increasing on the credit side, right. Okay, we needed some more capital, so we sold some stock for $19,000. All right, cash goes up because $19,000 was just given to us for this stock, and that happens with the debit, 19. Capital stock is an equity account. Okay, equity accounts, like liabilities, follow the same rule. Debit is a decrease, credit is an increase. Well, we're issuing stock. That means capital stock is going up, and that happens with a credit. Study this carefully for me, please. All right, here's another case of the accrual system where we separate revenues and expenses from cash. We have sold on credit before. We sold $5,000 worth of goods in our second or third transaction. And we gave birth to an account receivable because we sold on credit. So now we're collecting it. We don't record the revenue again. Don't make that mistake. We've already recorded the revenue. You cannot book a sale twice. But cash is going up. Debit $5,000. What's changing? What's being credited? Accounts receivable. Because like our accounts payable, once you pay something, like our insurance payable, remember that? Okay. Once you pay a debt or receive money that's owed to you by someone else, then that obligation no longer exists. Okay? You're only going to pay a debt to me once, aren't you? Unless you make a mistake, I'll be more than happy to take your money twice. So I had a receivable from you. I don't anymore because you just paid it to me. So that receivable goes away with the credit because it is an asset. So one asset is debited, one asset is credited. Here's where we're paying for the $2,000 worth of inventory that I bought on credit. This is just like the preceding entry, but this time my money's going out instead of coming in. So I eliminate a payable, which happens with debiting a liability, and I credit cash, which is an asset, because I'm writing a check. Okay. My landlord wants a check for next 4 months, I stand corrected. And I haven't used up this item yet, and if I've got something I paid for that I haven't used up yet, it's an asset. It will benefit me in the future, but it has not yet been consumed. In this case, it's the rental of space. All right, so I've got to debit something, right? That debit will go to prepaid rent, an asset. That's not the same as rent expense. All right, later on as the months go by and I do occupy this space, then I'm going to chip away at that asset piece by piece and transfer it $1,000 at a time, because this is for the next 4 months, over to expense. Okay? So every single month for the next 4 months, I'm going to have to remember to take $1,000, debit rent expense, and credit prepaid rent. Now, we've already paid the cash, so no more cash will be changing hands. This time, we paid the cash before we incur the expense. It can happen either way. Okay. Here are a couple of other transactions. All the ones we looked at were already studied. Now we're adding a few new ones. We're going to buy some land. Then we're almost immediately going to sell that same piece of land. We don't have any land. How do I know that? Look back at our trial balance. If there were land, if we had already bought land, you'd see it as an asset. So right now we don't have any land. Okay. We're going to buy it and we're going to sell it. Now think about that. We're buying it for $8,000 and selling it not long after for $11,000. Not bad, huh? You just made a nice little profit on that deal of $3,000. How do you book that? We'll see. You're going to get $3,000 in cash from a customer before you do the work, like my landscaping example. And we're going to pay a dividend to our stockholders of $600. Okay, here's what happens. By now, I think you've gotten a pretty good feel for debits and credits and following the roadmap I gave you. So, when you buy land, cash, $8,000, how do you record that? Well, you're buying an asset. Okay, so you're going to debit land. You're paying cash. Cash is decreasing. That means you're going to credit cash. Fair enough? Okay. Now, a couple of days later, you're going to sell it almost immediately. And by the way, I did see this happen in my career once. It was kind of a bad deal. Sometimes it works for you, sometimes it doesn't. But stuff like this can happen. So here's the deal. That land is sitting on your books for $8,000. Okay? You just made that entry. But now you're selling it for $11,000. So you've got to do a couple of things. Number one, debits have to equal credits. You already know that. Okay. So, as we see up here, we're selling it for cash. Cash of $11,000 comes in. Cash is debited for that 11 grand. You have to get the land off your books now because it's not yours anymore. But it's only on your books for $8,000. Okay? So whatever it's on your books for, it's got to go. And an asset decreases with the credit. So now there's no more land. It's gone. But you don't have a balanced entry. You've got a debit of 11,000. You've got a credit of 8,000. What do? Well, wait a minute. That's a gain. That is not revenue, okay? Because we're not in the land selling business, okay? But we saw a chance to make some money and we took it. So if something is outside of our normal course of business, we call it a gain, all right? And gains are going to follow the same rule that we follow over here. Gains are just like revenues. Okay? Except that we don't want to classify them as revenues because we're not in that business. We want to show them as extraordinary, incidental, outside of our normal course of business. Way over here, if we had lost money on that land, it would have followed this rule. Okay? So revenues and gains behave the same way. Expenses and losses behave the same way. Okay? All right, so now, because gains and revenues follow the same rule, it increases with the credit. We're going to credit gain on sale of land. And that increases with the credit, and now my debits and credits all equal. Study that one carefully for me. 2 more to go. They took a moment and showed us the effect on our master accounting equation. Now remember, we're using these temporary accounts for now to gather our information, but eventually everything that is a revenue expense, a gain or a loss is going to end up in retained earnings, and that is an equity account. So this little illustration shows you that we do have a balanced entry. This equation still works. There is 11 minus 8,000 on the asset side, and the $3,000 difference is going to ultimately end up in equity. All right. Now, we saw that when we paid our landlord before we occupied the space, that in the meantime we had to show it as an asset. Later on, as we do use up that land or whatever the expense happens to be, we have to transfer part of that prepaid rent over to expense. This is the same thing, except it's the mirror image. This time someone is paying you a slug of cash before you've done the work. Okay, now the accrual system says until that work is done, well, that is not revenue to you. You can't do that. You can't show it as revenue. You got to put it somewhere. You have to park it somewhere in the meantime until you do the work. Well, just like we took an expense that hadn't been incurred yet and made it an asset, I'm going to take this and make it a liability. So we get a check for $3,000, cash goes up, asset is debited. And instead, this is like the opposite of prepaid rent. We're going to call it unearned revenue, and it is a liability. Okay? It will become revenue as we do the work. Now let's think about that. You pay me to do your work for you in the future, so I haven't earned it yet. So I have a liability to you. Why? If I end up not doing the work, you're going to come to me and say, Alan, I want that money back. You don't have a legal right to keep it. So until I have earned it, if I do the work and then you want your money back, that's tough toenails. You're not going to get it. So in the meantime, because I might have to pay you this money back, if I never do get that work done, that's the logical basis on which I'm going to call this a liability. Okay? And unearned revenue being a liability increases with the credit. And finally, we have a dividend that we're paying, $600. So look at the rule that dividends follow, okay? They are debited to increase, credited to decrease. So we're paying a dividend. we increase it. It's not an expense. It is a special type of an account that I'll get into maybe later in this chapter. I'm not completely sure. But it increases with the debit. What is the credit? Obviously, it's cash. As soon as you see that word, well, I didn't see the word paid, actually. It said distributed, but that's the same thing as paying, isn't it? Okay? All right, very good. So, let me see. I have brought us up through page 140. Bear with me. The dividend was the last thing we did. That's page 146. So, if you're following along in the book, it's page 146. And I'm on or about, if you've got the e-text, around table 4.33. So hopefully that's helpful to you. It's time to end our discussion today, so I will disconnect and I'll wish you a great day, and I hope you're continuing to stay safe. Bye-bye.